Many investors recognize the S&P 500 as a key stock market benchmark, but fewer are familiar with the VIX, often called the fear gauge, because it reflects how anxious or confident investors are about the market's near-term future. Introduced by the Chicago Board Options Exchange, CBOE, in 1993, the VIX tracks how much traders think the S&P 500 might swing, up or down, over the next 30 days. When the VIX rises, it signals higher expected volatility and more worry about potential market drops. When it stays low, investors typically expect steadier, less dramatic price moves. The VIX matters because it serves as a quick snapshot of market sentiment. A rising VIX can be an early warning that investors are getting nervous about everything from global events to corporate earnings. It also influences how portfolio managers and everyday traders make decisions. Behind the scenes, the VIX is calculated using the prices of both call and put options on the S&P 500. The Volatility Index relies on a specialized formula published by the Chicago Board Options Exchange, CBOE, which aggregates the prices of both call and put options on the S&P 500 that are set to expire in roughly 23 to 37 days. The result is an annualized number, meaning that if the VIX is at 20, it implies about a 20% fluctuation, up or down, in the S&P 500 over a year. Some investors break that down further to a 30-day perspective, interpreting index at 20 as roughly a 5.8% implied move in either direction over the next month. The VIX didn't always focus on the S&P 500. Its earliest version used options on the S&P 100 before being updated in 2003 for a broader view. Historically, it has spiked during times of crisis, such as the 2008 financial meltdown and the early days of the COVID-19 pandemic, sometimes soaring above 80. Traders use the VIX in several ways. Some treat it as a hedge by buying index-linked derivatives, hoping that a market drop will send the index higher and offset their stock losses. Others speculate on volatility alone, trying to profit from bets on whether the VIX will climb or fall. The volatility index might look like just another market metric, but it carries tremendous insight into how investors feel about the future. Understanding its calculation, historical context, and practical uses can give you an edge, helping you manage both the risks and opportunities that come with stock market volatility. And remember, in a market guided by fear and greed, the VIX is the alarm bell that rings out just how loud that fear is.